Welcome to the Snowbirds Expat Radio Podcast. I'm Gerry Scott, founder of the Snowbirds US Day Tracker and the Canada Physical Presence Tracker app. Good morning, good afternoon, good evening, wherever you may be, and whatever time you're going to listen to this podcast. We've got a really interesting guest on the show today, and as we're doing our homework, today we have John Demetri with us. He's from Baker Tilly. Baker Tilly is right now, as of last year's stats, is the seventh largest accounting firm in Canada, head of M&P, and just behind Smythe, if I'm pronouncing that right, John. We don't work with anybody at Smythe or Smith, so you're safe. You're safe. But anyhow, John is congrats, John. He became a partner this year of Baker Tilly, based in Vancouver here. And before that, he was a senior manager. And John specializes in what we like to discuss, cross-border issues, may it be Canadian tax, U.S. tax, or that really messy in-between Canadian cross-border tax, may it be for personal or for corporations that John acts for. So, John, we got to find out a little bit more about yourself. Where are you from? How did you get into the accounting world, and what did your parents do for a living?
I've been in the accounting world for over 15 years now. I was born and raised in the Vancouver area, in one of the suburbs here. And my parents are immigrants. They came over from a country called Cyprus back in the late 70s. And I was born here, as I mentioned, and have been studying accounting and helping clients with their cross-border issues for a while now.
Okay, well, we really appreciate your time, and I know how busy you are, so I'm going to try and get through these questions as quick as I can. So today what we're going to be discussing is, it's really going to, anybody who's planning on leaving Canada or planning to move up to Canada, or, like I say, leaving United States or leaving Canada, we've got some great questions for you. So, John, we're going to jump right into it. And I'm sure that these questions can be difficult for most people to understand, but because you are the expert, we're going to have a lot of fun with this. So really, the first question we have is, what are some of the things to consider when a Canadian is leaving Canada?
Well, the first thing you have to look at is whether you've actually met the requirements to cease tax residency. And the first question is, why would you want to, or why are you required to? And the goal there is to kind of sever your ties with tax filings here in Canada where possible, so you're not reporting your worldwide income to Canada. And typically when we see a lot of individuals moving to the U.S., that's generally more advantageous. Given tax rates are a little bit lower, obviously, in the U.S., so you don't really want to be subject to the Canadian tax if you're not planning on returning for the foreseeable future and you meet the requirements. So the main thing first is you have to determine whether you can actually cease if you've met the requirements. And it's not really defined in the Act per se if you've ceased to be a Canadian tax resident or not. But what they do look at is it's a kind of a question of fact, and they look at ties that you continue to have with Canada once you've left. And there are two significant ties that they look at, and then there's additional ties that they also look at. The first two significant ties is the location of your dwelling. Where do you have a permanent home? So, for example, if you lived in Canada and you sold your home and then you moved to, for example, Washington State, and you purchased a home there, clearly you've severed that tie because that home is no longer available for you here in Canada. The second major tie that they look at is, where is your spouse and dependents, if you have any? Have they moved with you to that new location? If they haven't, that is a significant tie that keeps you somewhat locked to Canada. And once we look at these significant ties, then we kind of look at secondary ties, such as those economic ties, employment location, financial interest, where your bank accounts are, where personal property is located, where do you have medical insurance, where is your driver's license issued, things like that. And we collectively look at that to see whether or not you still have a significant grasp here in Canada. And the goal is to sever as many ties as possible to be able to show that you've actually left the country.
But one of the thoughts that I have, and I was going to leave it for the one of the last questions, though, is that we are coming across Canadians that have green cards that are spending half their time working in the United States and half their time working here in Canada, and they've never really severed any relationship whatsoever with Canada or United States. Is that common?
It can be, but we need some professional help should be looked at there because you really shouldn't be filing as a resident of two countries if you meet the requirements under U.S. domestic law to be considered a resident and the requirements under Canadian domestic law. You don't want to be in a situation where you're filing as a resident of both. And there may be reasons why a taxpayer may wish to do that. And, we're not really going to get into those specifics. But, at the end of the day, there is a tax treaty between the two countries. And it's very rare that you can't sever to one or the other.
Okay, so another question that we have in front of us here is it says determining if you have assets subject to Canadian departure tax.
Yeah, so one of the things that happens when you do cease to be a Canadian tax resident is some of your assets or all of your assets basically are subject to what's called a departure tax unless they're specifically excluded. And there is a list of items that are specifically excluded. And we can kind of go through that in a little more detail shortly. But basically, what is a departure tax? A departure tax is a capital gain on untaxed gains. So, for example, if you had some shares in a company that you owned that had an unaccrued or untaxed gain of, let's say, $1,000, when you're leaving Canada, what would happen is that gain would be triggered even though you're not actually disposing of the asset. So some common assets that are not included for purposes of the departure tax are, for example, cash, personal use property under a certain specified value, your Canadian real property, such as a home in Canada. Generally, pension plans, such as an RSP, are also excluded. Things such as your tax-free savings accounts and RESPs. However, the recommendation is that you do speak to an advisor at that time, because it's an important thing to understand what your exposure is, as there may be a significant tax liability with regards to departure tax. Because depending on what your unaccrued gain is, it can be quite significant, right? You'd be paying your capital gains tax. Now, there are opportunities to defer this tax and to unwind it in the future. And we obviously aren't going to go into that much detail on that, but it's important to understand that when you leave Canada, you don't just get to leave scot-free, if you will.
Well, I hate to see you use my name in vain there, John. But here's something else. And like I say, there's a lot of thoughts that kind of go through my head. So let's say, for example, a Canadian person is not 100% sure, depending on the visa that they obtain in the United States. And maybe this is a 3-year visa, or maybe it's a 1-year visa or a 2-year visa. What do they do in a situation like that where to go through this entire circus act?
So unfortunately, immigration is not taxed for Canadian purposes. We don't look at your immigration status to determine your tax status. As mentioned, we still go back to those preliminary ties and the secondary ties to determine whether you're a continuing resident of Canada. The U.S. has it a bit different in the sense that they have a days test that must be met. And if you're considered a resident under their days test, then generally you would have to look at the tax treaty to determine whether you're a tax resident of one country or another. And I appreciate the fact that, you may not be there for a long term, but, you do kind of have to look at those ties and whatnot. And that's just how it works. If you are going to be there temporarily, speaking to an advisor, maybe there's some form of position that can be taken, but generally speaking, it does go back to those ties and whether you meet the requirements under each country's domestic law to be considered a resident and what the tax treaty between the two countries would say.
Now, how common is it for a Canadian? I mean, like when we talk about traffic, and is this becoming a very common practice for Canadians to be moving down to the States?
So it is. It depends on the facts and circumstances. We typically see two types of moves or somewhat moves, if you will. First, you have the individual that actually obtains a job in the States, and they pack up their home and they move to the States, and those ones are clear cut. But then you have the ones, for example, I'm retired and I want to spend 6 months in Arizona because it's warmer. Those ones are, again, are pretty easy to determine because basically, if you maintain your ties to Canada, you would still be considered a tax resident of Canada, and the U.S. allows for exemptions if you're careful on your day count and you file specified forms. So generally, you can determine whether you are a resident or not. And the last thing you want is for the tax authorities to come and tell you whether you're a resident or not, because you might find yourself with a surprise tax bill.
Now, you did mention that there are exclusions from the departure tax.
That's right. So one of the exclusions is if you decided to come up here, you're new to Canada, you never filed a Canadian tax return, and you meet a threshold whereby you're here for less than 5 years or 60. It says 60 months in a 10-year period. And basically, if you meet the requirements, then there may be an opportunity to exclude assets you brought into the country with you with regards to the departure tax. But that unfortunately would not exclude assets that you purchased while here in Canada. Now, speaking about the departure tax a little bit further, there's some other things that one should be aware of, especially if you're an owner of a Canadian corporation and you're departing Canada. There's a few things that need to be dealt with in the sense that the shares that you own in that corporation are likely to be also considered for departure tax. And that corporation itself may lose favorable tax treatment in the sense that it would lose its CCPC or Canadian Controlled Private Corporation status. So ensuring you understand those implications and what that could mean for your business before you pack your suitcase and go is also of extreme importance. And working with a professional that understands these rules is key to getting it right.
So what happens if that Canadian corporation decides to do business in the United States? So they're going to set up a new establishment in the United States. I guess that's a different thing because technically they're not departing Canada. They're just expanding in the United States.
So that is a bit different, a little bit out of scope of what we're talking about, but it's something that can be brought up. One would have to consider whether one would set up a branch in the U.S. or how they wish to do business in the U.S. Because that corporation, the Canadian company, may be subject to U.S. taxation and U.S. filing requirements depending on how engaged it is in the U.S. And some of the terminology we use there is whether it creates a permanent establishment in the U.S. And we also have to look at different state rules because state rules don't always comply with the federal rules. So yeah, that is a bit of a different topic, but one to definitely keep in mind when doing business in the U.S. from Canada.
Now, I'll do my best to try and, as these questions and thoughts come to my head, I'll try and do my best to load up the U.S. questions when we start covering U.S. side of things. Now, here's something that we've come across personally on the wealth management side.
Sure.
We had a client, he bought his house in 94 and he went and worked overseas for almost 25 years.
Okay.
And he always kept his principal residence. He came home and he would have sold it in the last year or so.
Oh.
So tell me a little bit more about that, because obviously he would have lost that principal exemption. Or how do they calculate that?
Yeah, so the question there is whether he was a resident or not. So assuming he was considered a Canadian tax resident for those tax years, and I'm not sure how strong that position could be, but we're not going to argue one way or another on that. They meet the principal, the consideration to be considered a Canadian tax resident, and they meet the rules for the principal residency exemption. Then technically that there could be an exemption on that principal residence when it's sold, but that's a very specific situation. You have to look at the facts and circumstances involved there to see whether A, are they really considered a tax resident for those 25 years, and B, do they meet the requirements of the principal residency exemption?
Well, in this case, he wasn't. It wasn't considered to be a principal residence.
It
But
wasn't.
they
Yeah.
used a formula. So let's say he spent his first 8 years here. So from 94 to 82, he was 94 to 2002. He was a Canadian resident, lived here, but then he left from 202 for the next. I guess it would have been almost 20 years when he came back in 2022. So how is that formula calculated? Is it
Yeah.
just the total years from the time he owned the place, or?
Generally, the formula that's used to calculate what part is exempt is the number of years that it qualifies as a principal residence plus one over total years. Uh, the consideration that you need to look at, and we kind of talk about what happens to your home shortly when you leave Canada, is whether there is a change in use. That's the key. So generally, if you decide to leave it there and you're not going to do anything with it and kind of keep it like a vacation home, then what you kind of discussed kind of generally would apply. But if you decide to rent out your home, at that point you have a change in use, and there's some considerations that need to be taken when you start renting out your home when you've left Canada and ceased to be a tax resident. And I'm happy to go through those at a high level with you if you'd like.
Okay. Okay. Now, once again, I am really biting my tongue here and biting my lip when it comes to these U.S. questions because, and
Yeah.
I'm not going to be disciplined here. I got to jump into a U.S. question. So we have a lot of snowbirds that have their homes down in the States, and a lot of them do not rent them out. They keep them for
Right.
themselves. But what happens if all of a sudden there's a legal contract on my place in Maui, and I decide to rent it out for an entire year? Am I changing the title from a Canadian tax perspective that could cost me to be in a capital gain situation?
Uh, Generally, yes, because there's a change in use at that point. So why don't we kind of go through some of the considerations, that because I have a few other things I'd like to bring up so that people are aware of certain things that happen when you end up ceasing to be a Canadian tax resident. So the first thing that you should do once you've done your analysis and you're comfortable with the position that you've actually ceased to be a Canadian tax resident, and the first thing you should do is notify people like you, Gerry, that I'm leaving Canada and I'm becoming a non-resident, so that the status of their financial accounts is correct in your system, so that appropriate slips and whatnot are issued in the taxpayer's name. Appropriate withholding taxes are done that need to be done, and it alleviates potentially the taxpayer from having to file a Canadian tax return unless they have certain specified sources of Canadian income continuing that would require them. And one of them would be continuing to have a rental home here in Canada, potentially. So a couple of things to note. One of the biggest surprises that many of my clients find out is that when you leave Canada, if you have a home buyer's plan, that balance is due. And if you don't make an RSP contribution to pay it off, unfortunately, it comes into income in your year of departure. So that can be a bit of a surprise when you weren't expecting to have, let's say, $20,000 of income magically appear on your Canadian tax return. It's important to ensure that you file those final returns to show that your tax residency has switched, and ensure that you're reporting the list of assets that you have when you left Canada. There's a required disclosure there. Again, certain exclusions apply. Also to calculate your departure class. And of course, it's important to review the rules of the country you're moving to determine what type of disclosures are required for any Canadian assets that you continue to have.
Okay. Now you bring up a very good point. So if a person was to leave the United States, you say they really got to check. California is an issue. Maui
California
is an issue.
Yeah, for sure. And I can kind of provide some context there. California is a state that is not very, don't wish to use the word friendly because that's not a very good word, but is not receptive to allowing certain things other states allow. And the first one is California doesn't follow the Canadian or U.S. tax treaty. The second thing is California doesn't allow for what we refer to as foreign tax credits. So if you have certain situations where things might be covered under the treaty, they would not necessarily be covered for California purposes. And a good example of that is, for example, a registered retirement savings plan, your RSP account. Under the treaty between Canada and the US, generally earnings earned within the account are considered tax-free in both countries. However, the example here is California doesn't recognize that treaty, so the income that you earn within your RSP while your thinking is deferred until such time as withdrawal, for California purposes, that's just not the case. The income would be actually taxable to you for California purposes. Another great example is, let's say you've left Canada and you decided to rent out your home in Canada while you're living in the United States. Let's say you started a job in California and you're earning rental income, and at the end of the day, there's some Canadian tax that needs to be paid. Now, obviously, you would claim that rental income on your U.S. return as a requirement to report worldwide income as a U.S. tax resident, and you'd be entitled to a claim for foreign taxes. But for California purposes, because they don't allow a foreign tax credit, you may find yourself in a situation where you're paying California tax on top of the Canadian tax, which potentially could be considered a double tax. So there are some pitfalls. So ensuring you understand the rules in the state that you're moving to, not just from a federal perspective, is key, because not all states follow federal rules. It's a bit different than it is here in Canada.
So, John, what is the best state to move to as a Canadian?
Oh, no, I don't want to have any favoritism, but if you wish to keep your tax life simple, Texas is definitely a great state to move to, as Texas doesn't impose a personal tax, nor a franchise tax or anything of that nature to individuals, at least. But obviously, one would move not because they want to find a favorable tax jurisdiction. One would move based on they have a job opening in a certain state, etc. Right? So we don't always have an opportunity to choose that. But I did want to take a little bit of time to kind of discuss some considerations some of our listeners may have when they have a Canadian rental property and they've left Canada. So generally, the rules for that is that you're required to have withholding taxes done on the gross rental that you receive from your rental income. However, there are a few things you can do as the gross rental tax that's withheld is a significant burden. So what one can do is there's elections that can be made to reduce the withholding tax on a net basis or estimated net of what your net rental income would be versus gross, and you can elect to file a Canadian tax return to report that rental income, which allows you to claim expenses and pay tax on a net basis. So that's one of the things you need to consider. And if that was your principal residence, because technically there would be a change in use when you start renting that property, there is an election that you can do to avoid having a change in use at the time you leave and start renting it, right? So, you need to talk to your advisor to determine whether that election makes sense, because if it's not done, technically you've disposed of that property. Now, there might not be a taxable situation because it was your principal residence before you actually deemed disposed of it. But on a go-forward basis, any accrued gain would be taxable. But by doing an election, there's an opportunity to potentially save and not have that change in use. So I just want to reiterate that because it's kind of important to discuss that election with a tax advisor.
The other thing that we did discuss over lunch at one of our favorite places in Vancouver, Carderos. Am I saying it right? Carderos. I'm sorry. Right down the waterfront there.
Yeah.
One of the issues that we came across was, you're right, when these people leave, they have these large RSPs, they leave Canada, they go into states like California, Hawaii.
Yeah.
There must be a checklist that you guys are following to say, listen, this account needs to be crystallized, not cashed out or cashed in, but your investment holdings need to be crystallized, because you're going to be carrying that capital gains into the United States, and any changes in management of that portfolio will trigger state tax.
Yeah, it depends what state they're moving to. Like if we have somebody moving to Washington State, we're not too concerned because there's not going to be a Washington State tax generally imposed. Mind you, they just came out with a capital gains tax, so they are changing things a little bit down there. But yeah, you need to look at that because if you're going to a state that doesn't follow the treaty, because generally what would happen is you may be entitled to a bump in basis for U.S. purposes for assets that are subject to a departure tax. So yeah, you do need to look at that because it might just make sense to crystallize your gains working with an advisor such as you, so that, and then maybe repurchasing the asset, it might make more sense at that point, especially if you're going to be subject to the departure tax on that same asset.
Now, how many states are like, we know that there's got to be 40 plus states that have state tax, federal tax, but how many of the states out there really do function like California where they don't recognize the treaty between Canada and the United States?
Yeah, there's a good handful of them. I wouldn't happen to know them all off the top of my head. We do look it up as we do. Being on the West Coast, the main states that we do deal with are Washington, Oregon, and California, but we do work with Nevada, and we also have an office in Toronto. So we are working with people in Massachusetts, New York, etc. Most do comply, I would say, with the treaty, but you do have to look at it on a state-by-state basis. And there's certain states that comply with certain things that are federal and certain things that are not in the federal code. So you do need to have a good understanding. And given the fact that you're coming in as a Canadian and have Canadian issues, having an advisor that kind of understands that is important.
Okay.
Because one of the things that we notice is you have a Canadian that moves down to the States and they've got all these lovely financial accounts here in Canada, such as their RSP, maybe a bank account that they keep. And sometimes we find that a domestic advisor may not be cognizant of the fact that those accounts need to be reported to the Department of Treasury on what we call a foreign bank account report, an FBAR for short. And being delinquent on some of those forms can be detrimental to the taxpayer, as the fact that some of them carry penalties of $10,000 US. So ensuring that you have an advisor that does understand the different requirements is important.
So you must, when do you sever ties with that Canadian that moves down to the United States? Do you try and maintain that relationship?
We generally try to maintain that relationship depending on the assets that they continue to hold in Canada. We have a newly graduated student that just got a job in the United States and really doesn't have very significant ties to Canada, no bank accounts or minimal items. And, at that point, we may want them to move on to have a local account assist them. But if you have an individual that has significant wealth, trusts, etc. here in Canada, maybe a corporation that's continuing to run here in Canada, that's where you definitely wish to work with a cross-border advisor versus a domestic accountant, as they may not be aware of all the issues that are present, whether it be from a Canadian or a U.S. perspective.
Okay, I'm going to put on my compliance hat. I've seen this a few times in Canada. You get these people moving from Canada to the United States, and what they do is they provide their Canadian addresses for these accounts. Maybe they're using their parents' accounts. What are they creating? What kind of a mess are they creating by doing that with the RSPs are, we see that. But what about the Canadian investment accounts to avoid the departure tax?
Yeah,
how silly is that?
It's silly because if it were to be looked at a future date, they may find themselves having the CRSA actually, you departed Canada 3 years ago, and you are subject to the departure tax on these assets, and these disclosure forms are now late, and the departure taxes that should have been paid is now late, and they may find themselves in a bit of a financial mess. So ensuring that gets done correctly is very important, because you never know when the taxman's going to come knocking, and while Canada Revenue is typically happy if you continue to file as a tax resident because they continue to potentially take revenue from you. The rules are the rules, and you kind of need to follow them.
Okay, this is a great segue into this United States. Canadians moving from, or Americans moving from the United States and coming into Canada. And
Sure.
Let's start with that same question, is what happens if they don't, and we're seeing this more common, where they don't change the address for their investment accounts, and they don't change their address for their IRAs and their Roths and their 401ks. So once again, how much trouble does that put them in by not
So
forwarding an address?
I hate to say, from a tax perspective, it's not a significant issue. At the end of the day, the requirement is that we report worldwide income. There may be incorrect taxes withheld, etc., from the advisors because they're taking the position that A, you're a resident of a certain state and a continuing resident of that state when you're really not. I guess the issue is more from an advisor's perspective because I think that may be putting them offside, not understanding the correct tax residency of the investment of their client, right?
Yeah, from a regulatory point of view, a lot of these firms in the States don't have the ability to manage assets for Americans living in Canada.
That's
And
right. So it's more from that perspective, I would say that there's an issue. From a tax perspective, we're still going to have to pick up any income on both returns. As a U.S. citizen, generally the requirement is that a U.S. citizen files a U.S. tax return, whether they're living in the U.S. or they're living outside of the U.S.
okay, so we know that. So now we're kind of working our way backwards here. So we've got these Americans; they have these non-registered assets in United States, and they move to Canada, and they want to from a regulatory point of view, they're required to move their accounts over to Canada because you can't have an investment account. So what are we keep on hearing about a step up, and is there a tax paid when they move all those individual securities in kind onto into
Yes.
Canada?
Yeah, so for Canadian purposes, if you're becoming a Canadian tax resident, the Canada or how it works in Canada is you do get a step up in basis. So that means if I owned 100 shares of a company that was worth $1,000 when I bought it, but when I come to Canada, the fair value is now 2,000. For Canadian purposes, I get a step up in basis to $2,000, so that Canada will only tax me on the new gain going forward. That way, they don't tax you on what you've accrued before you came into the country. For U.S. purposes, there is no real step up there. You would still keep your original basis. So unless you actually dispose of the asset, there shouldn't be a tax implication from a transfer unless there's an actual disposition of the asset. If they're just moving the shares from one to another with no actual disposition of the underlying shares, there shouldn't be an issue. But speaking of that, there's a few interesting things that you can do. So if you're up here for a long period of time and you wish to move your IRA, for example, into Canada, there is an opportunity to transfer it to an RSP. It's a complicated situation and you have to kind of have all your ducks aligned for it to work, but there is the ability to do that. But the ideal situation I find with most clients is that they keep those accounts and they work with an advisor that can work on through the cross-border issues and can invest on both sides of the border. And that keeps things a lot simpler because sometimes you just don't wish to dispose of all your assets because there might be accrued gains and move them into Canada, right?
Yeah, and we've always told people that if you're an American living in Canada and you're receiving retirement pensions, income in U.S. dollars and spending those in Canada, that is not the biggest problem I've ever come across in my lifetime. It's not so bad. So getting back to this, when they move their accounts from United States in kind to Canada, they get the step up. Is there any future tax obligation? Like, we know there's a $2 million threshold. If you've got less than $2 million individually or $4 million as a couple, is there a departure tax on those assets if they move them?
So that applies to what you're trying to refer to. There is the expatriation tax that may apply to a green card holder, for example, if they're giving up their green card and they meet certain requirements, i.e. a net worth requirement or an income requirement. You kind of have to go through the steps. But basically, there's a market-to-market regime there in the U.S. So if you're giving up, or let's say you're giving up your citizenship, or you're a long-term resident of the U.S., typically 8 years is what the rules stipulate, you might be subject to a similar departure-like tax when leaving the U.S. and coming to Canada.
Okay.
But generally, as a citizen of the United States, if you continued to be a citizen and you moved out, there would not be an expatriation tax to you.
Okay, so we're moving this $2 million account in kind, all individual securities, and let's say it's worth 2 million. They paid 1.5 million for it. They moved that to Canada. Will that American person who continues to be a U.S. resident, they move that account to Canada. Their cost, do they get the step up as well, being a
So if
U.S.
it's in an
person?
IRA, would not, right?
No, I
Because
realize, but non-registered.
yeah, they would. Yes, they would for Canadian purposes, not U.S. necessarily U.S. purposes, but Canadian purposes. Yes, they would get a step up in basis.
Okay. So that $500,000 of gain on a non-registered account for an American person, would that be seen as a tax that they would have to cover off? Well, or would they also get
Well, as
a,
long as the asset's not disposed of, and it's just
okay,
mainly transferring the share certificates from one account to another. No, I'm not too familiar exactly how it works from the brokerage perspective, but if there's no actual disposition of the underlying asset, then no, there's no disposition. Hence, there's no tax to be paid by the U.S. citizen uh, from moving the account. But if for whatever reason the asset gets disposed of and repurchased, or it could be viewed as a disposition, then there could be an issue. That's correct.
okay, and because they're filing U.S. tax returns, they could have to report that on their
Correct.
U.S. return. Okay,
Correct. Yeah, if there's a
okay,
disposition, there would have like an actual sale of the underlying asset, and there's no tax exemption or anything like that available to them. They may be subject to a capital gains tax. That is correct.
this might not be the right place to ask the question, but um, when you talk to these Canadians that are surrendering the green cards,
Right.
when should they surrender that green card?
Ideally, before they're considered long-term residents, if they meet the requirements for the expatriation tax, right? So ideally, as soon as you know you don't really need it, you should be getting rid of it because it does require you to continue filing in the U.S. generally if you have a green card. And so why would you put yourself in a position of having to continue U.S. filings and also file in Canada, right?
Um, some people don't realize that they become a U.S. person they apply for a green card, they
Yeah,
get the green card, and for whatever reason they haven't moved down to the States yet.
sure.
But what damage could they do by becoming what is the term? Accidental American, I think is the term they use. What happens if they get that green card? Now they've got their principal residence in Canada. Does it kick in, or is it more of an exit before you have to worry about anything?
No, it kicks in actually, and it's the disclosures that may get them. It depending on what assets they have, etc. There may be requirements to disclose them to the IRS, and if they choose just to ignore it, they could find themselves in some hot water for sure.
Um, have people ever been able to? I mean, the green card application is a long process.
Hmm. That's my understanding. I don't really assist clients with that as that's more of a legal issue, but that is my
Yeah,
understanding is it's not simple to get a green card.
but have you seen that where some people get a green card and then they decide, I don't want to move down there, and now they've got all these issues that they have to deal with?
Yeah, it's not as common. Typically, if you're going through that whole process, your intention is to move. But yeah, and then the recommendation is to relinquish it as soon as you can to avoid having any future issues or at least mitigate the ones that you currently have.
Well, if you can imagine when you work this space, sadly the stories you hear
Yeah,
of the information that people don't understand or not getting good advice or even
I,
working with advisors that aren't cross border. It's
yeah.
tough out there.
I think the main reason people don't quite understand it is they equate the two systems of being very similar, but unfortunately, in some ways, they're just not. Canada is like the majority of the world, 99%, where we do things based on tax residency. Whereas the US system is a little bit more immigration based and it's based on your citizenship. So if you're a US citizen, you kind of always have to file a US tax return unless you meet certain exemption, etc. Whereas a Canadian, if you do sever your ties and you do cease to be a Canadian tax resident and you don't have any specified sources of Canadian income, you generally are not required to file a Canadian tax return going forward, which alleviates you of a lot of the issues, whereas it doesn't work like that on the U.S. side, and typically a green card holder is taken into those issues as well, even though they're not a citizen. And that's where that your question and concern kind of comes from.
Okay, every account we have on the Snowbird USD Tracker podcast, sorry, the Snowbirds Expat podcast, always got to put a plug in there for our app, John. What is your opinion of a U.S. person holding a tax-free savings account when they live in Canada?
Yeah, generally it's not advised, and there's two reasons for that. There is some conflicting views out there on it, but it may be considered a trust or foreign trust for U.S. purposes, and that requires additional disclosures to that U.S. person on their personal tax return, which can be costly due to the compliance costs. And the other reason is it's not really covered under the treaty, such as an RSP or under the retirement area, which means that any earnings that U.S. person earns in the tax-free savings account is fully reportable to the IRS. Therefore, the tax-free nature of it kind of goes away, if you will. So accordingly, because of the potential issue of the additional disclosures, and that disclosure does carry a heavy 10K penalty with it, and the fact that it may not be tax-free in nature, the general advice is consider not having one.
Okay, I've got two questions left before you get you back to your day here, but the first question is when an American moves to Canada and they have their Roth IRA.
Oh, good question.
The election.
That's right.
Filing an election.
You're supposed to file an election if you want to keep that account tax deferred. And technically, you should not be contributing to the Roth IRA while a Canadian.
You know, I know people are going to be listening to this and they're going to be saying that's not fair because we talk about a TFSA and we talk about the IRA. You can bring your IRA to Canada, file the election, but your TFSA you can't bring down because they don't recognize it. So my last question is, when do you think that this tax treaty is going to be revisited, and what changes need to be made?
That's very interesting. I haven't heard anything about the treaty being revisited, but it would be nice to see at least some stronger guidance on the tax-free savings account. That would be great, and it would be nice if some states that don't currently conform to it would. That would definitely make the lives of many taxpayers crossing the border a lot easier.
Okay. Well, John, I got to tell you, I've taken a lot of your time today. I really appreciate your insight, your knowledge. We do share a lot of mutual clients together, so we've had the opportunity to get to know each other quite well over the last 3 or 4 years. So truly appreciate your time. Before we let you go, is there anything else that you want to add? Canadians moving to United States and Americans moving to Canada.
Yeah, the main thing I would say is just work with an advisor that's reputable, because you don't wish to find yourself in a situation where you're non-compliant, because being non-compliant can lead to financial burdens that you may not wish to be in.
Wonderful. Well, thank you, John.
My pleasure. Thank you.
Thank you for listening to the Snowbirds Expat Radio Podcast. Our app is available for your iPhone and your Android. If you have any questions, call me 604-612-7526. Until our next podcast, I'm Gerry Scott.